It was an interesting way to start off the month of September with the S&P 500 appearing to nosedive into the open here this morning, only to come rallying all the way back and close in the green. So we ended up having a pretty nice looking long lower shadow on our candle here today. Could potentially become a hammer as soon as tomorrow. Tonight's video is jam-packed with lots of interesting data points, including some dividend information regarding which sectors are the most attractive at this moment in time. We're also going to take a look at the utilities sector and see that it had a quite impressive bullish engulfing candle at an important support area here today. And then I want to get into my trade application example. It's somewhat similar to the idea I presented to you on Tuesday, where we have a fairly rare 3% dividend yield on a dividend growth company where a put selling opportunity seems to be emerging. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 1st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list. That way you're notified whenever we post these videos. At the bottom of those emails, you'll also get a heads up as to which stocks in the S&P 500 are giving you overbought and oversold cluster signals. As I'm sure most of you have recognized this week, we've had a lot of oversold cluster signals. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee. I'd encourage you to follow me if you're not doing so already. Remember, sometimes I'll let you know in advance what our trade application example might be by posting something about it on Twitter ahead of time, as was the case on Tuesday and here earlier today on Thursday. So for those of you that want to stay up to date with all of my tweets, remember you can hit that bell notification icon, and that way you are notified whenever I post a new tweet. Lastly, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, we've got our S&P 500 heat map. And finally, we've got a little bit of green out there. It feels like it took forever as the markets have been mostly straight down for the last week. But after a rough start to the session this morning, where the market was actually down over 1% at one point while I was in my question and answer class here this morning, we had a pretty epic recovery into the close and ended up having some nice long lower shadows and some buying pressure into the close, where we actually did end up closing in the green on most of the major indices that are out there. And so this heat map here kind of reflects that. And one of the things I was mentioning, I think I might have even mentioned it here on Tuesday. If not, it might have been in my class yesterday. But somewhere along the way, I was mentioning how the first trading day of the month tends to be a bullish one. And so, there was always that chance that although we started a little bit weaker here today, that because today was the 1st of September, that we would have a decent chance to see it close in the green. And that's exactly what ended up happening. In terms of any consistency out there, I would say that it's a little bit kind of hit and miss there. It does seem to me that healthcare was pretty consistent today. In fact, we had a good conversation about that here in class today. Hello, Irene, and others who are in that class, but chatting about stocks like AbbVie and stocks like Bristol Myers Squibb and stocks like Merck doing pretty well here today. And remember, they had been kind of sitting out the rally here in the last month or so, and we're kind of going down at the time when the rest of the market was going up. And then here in the last couple of days, a lot of those major pharmaceutical companies were actually going up while the market was going down. So kind of interesting to see the relationship there. But anyway, it did seem like healthcare was a bright spot here today. I would also say that utilities looked pretty strong today. Take a look at all that green down there in the utilities area. Very little in the way of red. There might be one right there. Yeah, it looks like energy. Say that a bunch of times. Ticker symbol NRG was down 0.29% today, but otherwise you can see lots and lots of green there. Pretty much all the rest of them did close in the green. Discretionary did pretty well today. Some of the bigger players like Amazon, Tesla certainly helped out. Home Depot had a nice recovery there. They've been sliding a little bit earlier this week, but kind of had a strong recovery here. I do see that Starbucks is on the list as well. Some news about Starbucks after the bell here this evening, they did select their permanent CEO moving forward. And so Howard Schultz, as many of you are aware, was not the founder of the company, but he took an early leadership role in developing Starbucks to what we now know it as an international behemoth. Anyway, he had stepped in after Kevin Johnson had retired and has been kind of the temporary CEO, but he will relinquish the reins there to a new CEO moving forward. So we'll see if that can light a fire under Starbucks. Obviously, a stock that a lot of folks have an interest in, whether you're just a pure growth investor or more of a dividend growth investor. Starbucks has kind of been an interesting one there over the years. You can see that consumer staples did reasonably well here today, with stocks like Walmart and Procter & Gamble doing pretty well there. We even saw a little bit of positivity out of the communications area. Notice that Alphabet was up over 1%, and guess what? There's Comcast. How about that? That was our trade application example 2 days ago, and that one has rebounded nicely since that trade application I presented to you 2 days ago when we did the bullish trade of selling a put, when it gave us that 3% dividend yield for the first time in its history. It's been up 2 straight days pretty sharply there, and all of a sudden is actually up on the week after being at its weekly lows when I presented that idea to you guys there on Tuesday. Also, I wanted to point out real quick, if I can find it here. Yeah, there it is. Cisco Corp did end up closing down on the day, but we had some bright news early this morning when I noticed that our short selling trade idea that I presented here in this video a few weeks back did hit our max gain this morning. So it worked out beautifully, where we got out of our bearish trade when the markets were bearish, and then when the market rebounded in the afternoon, we had already locked in our max gains on that trade. So congrats to any of you who might have taken that bearish trade there, in addition to those of you that might have taken this bullish one on Comcast. So far, so good. Obviously, we're not going to win them all, but we sure like it when we do. So anyway, let's talk about some of the negative performers here now. And I would point out energy first and foremost, because as you can see in this kind of block down below here, all of the energy stocks were in the red. So if I right click and kind of zoom in only on energy, you can see all of them in the red, and some of them pretty considerably in the red. Something like Devon Energy was down 3.5%. Marathon was down nearly 4%. Some of these others like Exxon and Chevron down a little bit less because they're kind of heftier companies that don't move around with quite as much volatility. But all in all, it was a tough go of things there in energy. And remember, they had been kind of all over the map here in 2022. They started the year strong and were consistently strong for many months, and then kind of fell out of bed there in mid-June, only to eventually rise from the ashes up until last week. And now here we go again. It looks like we're rolling over in the energy patch, at least given what we've seen the last couple of days. Moving back to the S&P 500 now, another thing I think I should try to point out for you here is what's going on with NVIDIA. As you can see, that's probably the brightest patch of red that we see on this entire graphic. NVIDIA was the worst performer in the S&P 500 today, down 7.5%. After there was some news floating around that the United States government was going to limit their sales into China. And so obviously that's a huge market and is maybe good for security purposes for us that live here in the United States, but not good for NVIDIA shareholders that want to maximize profits. And so that stock did take a tumble here today, and it probably affected a lot of those semiconductor names around it as well. Most of the semiconductors did close in the red today. A handful of them managed to avoid that fate, like Texas Instruments closed up just barely there. But for the most part, that was, alongside of energy, the semiconductors kind of seem like that area where you were more likely than not to find a little bit of red in your portfolio today. So all in all, it was a pretty good day, especially considering how we closed, right? It's been a long time coming. I think I heard them say on CNBC today that markets were down about 9% in just this mini meltdown that we've had here over the past couple of weeks. And so that's a pretty aggressive move in such a short amount of time. As I mentioned to you on Tuesday, markets don't go straight up and they don't go straight down. So right now we were overdue for some sort of a bullish response. How long that lasts is, of course, the question. Remember, tomorrow is an important day because it's the first Friday of the month, and so we do have the jobs report coming out, the August jobs report, and so that has the possibility of having a little bit of volatility enter into the system. But you'd like to think that with as much damage that's been done in the market in just a couple of weeks, that some of that, any bad news that could be delivered could very well have already been baked into the cake, and maybe we're going to get a couple of days of upside here. I know from a seasonality perspective, it's typically early to mid-September where we have a bit more bullishness, and then it's in late September where we once again have more bearishness. Whether that holds with that pattern this particular calendar year or not is anybody's guess, but seasonally, over the years, that is what we have come to expect. So maybe, just maybe, we can get some sort of a bullish move into the September options expiration period. Let's keep our eyes on that possibility. Let's go ahead and move on over to the main part of the platform now. Talk about what's going on here with our breadth measures. We've got the S&P 500 pulled up in our visualize area of the Market Watch tab. And as you can see, there were 284 companies that closed in the green here today. And so that was good for about a 57% hit rate to the upside. And remember, if you would have looked at this first thing this morning, it would not have looked like this at all, because we were down over 1% here this morning, and I would venture to guess that probably 80% of the companies were in the red at that time. So it just goes to show you never know when some sort of a reversal will emerge, and today was the day that we've been kind of waiting for, and we'll see if it follows through tomorrow. Moving on over here now to our typical grid here. Remember, if you're a premium member of Market Scholars, you have access to all 50 plus of the customized charts that you see David and I using during our presentations. This one is 4B for those of you that are premium members. If you're not a premium member, of course, we'd invite you to become one. Remember, we'll probably be having a Black Friday sale coming up here in a couple of months, as we have pretty much every year. And up until then, you could always become a month-to-month plus member. I had a question about that in email here recently. So if you're a little bit nervous plunking down the premium money for a full 3 years with us, you could always try us for a month or two up front and attend our classes. You don't get access to all of our chart scripts and the digital assets, but you at least get access to all of our 8 trading rooms, and you can attend those trading rooms and watch their recordings to try to get a feel as to whether our program would be good for you for the coming 3 years. And then once we get into November, we'll have a nice sale for you there on the Black Friday sale. So something to consider. Obviously, you've probably found that David and I are not the arm twisting type. We don't like hard sales as individuals, and therefore we don't deliver that as business owners. So we are proud of what we offer, and if you want to be part of our organization, great. If you don't want to be, that's perfectly fine as well. But just thought I would throw that out there, since it was in the back of my mind as I was just answering an email about that here earlier today. Anyway, let's get into the analysis of our grid. And as you can see here, not a whole lot changed today from a posture perspective. What I would say is one thing that did change is one thing that I tried to alert you to on Tuesday when I said that be aware that there is a heightened expectation that the moving averages will turn red by the end of the week. Remember, on Tuesday, we already knew that the moving average had turned red on the Dow Jones Industrial Average. And I said, unless we get some sort of an epic recovery, assume that these other 3 charts will likely end up having red moving averages as well. And after today, that is the case. We checked the final box with the Russell 2000. Yesterday, the NASDAQ and the S&P 500 already were there, and I'm sure David shared that with you in his video last night. But today we can confirm that even the Russell 2000 now has a red moving average. And for those of you that are newer to this video presentation, the red moving average basically is just acknowledging that price is below a falling 30-day moving average at this moment in time. That doesn't guarantee anything, obviously, but it does go to show that the cut through the moving average has been aggressive enough where there is legitimate concern now about the durability of this market moving forward. right? And that's not to say we can't get some sort of a snapback rally. In fact, we've had so much damage, as I mentioned before, that I think there's a high likelihood of us getting some sort of a bullish move here in the short term. But my question is, what happens when we get back to the moving averages, right? We talked about the prospects of possibly getting some oversold cluster signals. We didn't quite get there, but look at how close we got. All of those were clustered up, but they were clustered up just a hair above the 20th percentile there on the S&P 500 and pretty much there on the Dow, pretty much there on the NASDAQ as well. And we weren't quite there on the Russell. You can see there was a little bit more of an air pocket between the green line and the lower reversal zone on that one. But the point is, whether it's precisely a cluster or from a psychological perspective, you're kind of in the neighborhood. It does go to show you how extreme the selling has been lately. And, as I mentioned before, markets don't go straight up and they don't go straight down. And so we could very well be in store for some sort of a short-term pop back higher. But when we cut through the moving average like this and then the moving average turns red, it kind of nullifies that possibility that that was a buying opportunity there. Now, if you're a long-term investor, I think you can be kind of nibbling at some stocks. I actually have this week. I bought multiple stocks in my own dividend growth portfolio, but that's been pretty rare, right? The last time I've done that was probably several months ago because markets have been bullish largely over the summer, and as a dividend growth investor, I want to buy stocks when they're cheap, not when they're expensive. So I've actually been going to work a little bit this week, not overboard, but just kind of nibbling here and there on some stocks that I think are somewhat interesting, knowing that this is likely not to be the bottom, but it will be hard, if not impossible, to actually identify the bottom when it's happening. So I don't mind buying some stocks along the way while they are falling, even if it's not the bottom, because they will be there to hopefully benefit whenever there is a sharp rally that becomes the bottom sometime down the road. So anyway, if you're a long-term investor, that's a different story. I think you can be nibbling here and there on select names. But if you're a trader, what we fear here in this case is that by cutting so sharply below the moving averages to the point where you're curling those moving averages over and painting them red, that's basically saying that any hopes for a buy the dips rally where you would buy them as it cut through the moving average for only a day or two, but then immediately respond higher while those moving averages stayed yellow, that's now out the window. Now, obviously, there's nothing that's a guarantee in the world of technical analysis, so this could very well, for anything that I know, sharply rally, just like we saw after COVID, right? That can happen. It's just that you're trying to establish any assumptions or probabilities in your head, and when we start getting these red moving averages, the probabilities of us ripping to new all-time highs is less today than I would have thought about it, let's say 4 days ago, right? And obviously, you have to keep an open mind in this business. You have to stay flexible with your thinking. So if something changes on the charts, then you have the opportunity to change your mindset as well. But I'm just kind of talking out loud here that, when we start seeing these red moving averages alongside the dark pink shading of the background color telling us that we have strongly bearish postures using the market forecast posture setting mechanism, that is usually a bad combination. We don't mind seeing the pink background colors combined with the yellow moving averages, but when you start combining the dark pink with the red moving averages, then it's starting to tell you that there's been a little bit too much wear and tear within the market and that your mindset should be leaning more bearishly for trading purposes. So, I hate to be the bearer of bad news from that regard, but that's kind of where we're at here all of a sudden. We had a chance to bounce, a couple weeks ago. Market didn't take it up on that offer. Instead, sold it off pretty violently, and therefore our mindset as traders has to change here when we're looking at this information. So anyway, point being, none of these had clusters. All of them were fairly close to oversold clusters. All of these are now strongly bearish intermediate postures, and all of them are now trading below their falling 30-day moving averages. The other thing I should point out is that I kind of mentioned this before, but now that you can see the charts, notice that we do have long lower shadows on our candles here today. Now, that does not guarantee that that will lead to upside action, but it is at least a starting point for that philosophy in the short term, right? A lot of you will identify those candles as what we would refer to oftentimes as hammers, right? If you see the exact same shape of a candle up at the top at the resistance, we would refer to that as a hanging man. I know that's not particularly PC in this day and age, but that's what the candlestick formation is called. But when that shape of a long lower shadow right there happens at a support area like you're seeing here, notice how like the NASDAQ, you have that long lower shadow basically touching this prior high right here on July 7th and this prior high right here on June 27th, where the concept of old resistance can become new support and you get a hammer candle right on that support. You know, that certainly ups the ante that this could be some sort of a short-term opportunity to reverse this market higher. But again, what we care about is how far will it take us? If it only pops higher for the next, let's call it 3 or 4 days, and then rolls over immediately underneath that falling 30-day moving average, that's not going to do a whole lot of people a lot of good, right? Most of you are not going to be in and out of a trade within, 3 days type of a thing. So you have to be a little bit more cautious around that mindset there. But just wanted to point that out because typically when you're asking, hey, are we near some sort of a short-term low? One of the things you should be asking yourself is, are you identifying long lower shadows out there? Because usually it takes a significant day like that where it looks really violent at one part during the day in the morning, only to reverse course and have the bulls own the day by the end of the day. And that's kind of what those candles are telling us there. So it was kind of interesting to see that with the S&P 500, we actually closed in the green, not by a lot, but by 0.3%. The Dow led today. It was up 0.46%, but somewhat surprisingly, the NASDAQ and the Russell 2000 still closed in the red today. The NASDAQ almost got back to break even. It closed lower by 0.26, but the Russell actually had a pretty bad day. It was down 1.16%. Now, it could have been a lot worse, and that's what that long lower shadow is telling you. At the worst part of the day, it was. So, at least you got that going for you. But, just to go to show you, it wasn't the most violent hammer pattern that you've ever witnessed. And remember, a hammer pattern usually needs to be confirmed the next day. So today is day one. If the markets close higher tomorrow, we'll then be able to look back at today's candle and say, yes, that was a hammer. But if the markets continue to slip, then it's just part of a continuation to the downside. So that's the other part that sometimes people conveniently leave out. Yes, they look like hammers, but you don't actually confirm it until the next day. If we close higher tomorrow and we close higher than today's highs on these different indices, then yes, you can look back at today's candles and say those were hammers at a support, chance of a decent rally in the short term, even though our intermediate term continues to be quite cloudy, if not downright questionable. All right, so with that out of the way, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support this free presentation here. And so hopefully you guys get value out of watching David and I on a regular basis on YouTube. And the one thing that we ask out of you, if you want to say thank you, is to simply click like for us there on Twitter. And you guys stepped up to the mic, or stepped up to the plate, I should say, for me this last time around. I keep a pretty good eye on how many likes I'm getting. As you guys know, as long as we're up and over 100 likes, I'm happy to do a full-length video for you the next time I'm scheduled to do it, including a trade application example. And you guys regularly do that. I think there's only been 1 or 2 times this entire calendar year where you guys did not get over 100 likes. So that is fairly typical. But usually our like count is somewhere around, let's call it, 105 to 110. I would say that's probably your average there. So this last time around, and remember, there was only 2 days between my video this time. With the Thursday video, you have all the way until next Tuesday to click like. So there's more days to accumulate more likes. So this was only 2 days as well, which enhances it even further. But the point is, there were probably about 15 of you that clicked like on Tuesday for me that had not been doing so prior to that. So thank you to those of you who are not only new at doing that this last time around, but of course all of you seasoned, loyal veterans out there that do it every single time. So thanks to one and all to do that. Let's give some shout outs here to some of you. Michael, thank you. John, thank you. Ron, thank you. HR, thank you. Charles, thank you. Ron, thank you. Jim, thank you. Ziad, thank you. I don't recognize your name, Ziad, so if you're one of the newer ones, appreciate the like there. Keep it up. There's Ram, there's Dennis, There's Paul and Jayesh and Serene and Pat and Jimmy and Brandon. Go Titans, right? Actually, I'm a Rams fan, but Brandon and I like to give each other a hard time there. He's one of our premium members. He's a big Titans fan, so very much looking forward to my fantasy football draft I've got coming up this weekend. Anyway, thank you to Kevin and Kuldeep and Lazy Boy Trader and Sedona, Jerry, Ed, SW, Paul, Michael, Kirk, Ayakipa, Phil, Gerald, Surendhar, Margie, DGI and Options, Sheila, Sudhir, Dave, Ann, Ken, Austin. You guys are great. I can't go through all of you. It just soaks up too much time, but I do like to give some shout outs there to just have you know that your likes do not go unrecognized. I see them all. I appreciate them all. Keep up the great work on your end. While we're over here, let's also have a little chat about something actually, before we get to that, let me also remind you that I had my question and answer session today for my premium members. And so that's one of the big benefits that you have when you become a 3-year premium member of Market Scholars is that David and I each teach a question and answer session. Mine happens to be on Thursday morning, and then David's happens to be on Saturday morning. So in addition to those premium only classes, we also teach 8 trading rooms. So I teach 4 trading rooms, David teaches 4 trading rooms, and then each of us teaches a question and answer session. And the question and answer session is a way for our students to be able to work directly with David and I to answer questions that are important to them, right? As opposed to just watching a recording somewhere. They get to work individually with us. And so a lot of them really enjoy that and take advantage of it. So today we had a conversation about the dividend stair-step sector stats. We had a conversation about ETFs from a trend trading perspective and whether it would make sense to make them coffee can holdings, if that sounds like a peculiar term. Watch the recording, you'll know what I'm referring to when we say coffee can stocks. I got a question about Hewlett-Packard as its stock has been coming down here this week and whether it would make an interesting candidate for dividend growth investing. I got a question about put selling, and congrats to David Samuelson out there if you're watching. So he's been dabbling with selling puts on dividend aristocrats like I teach in my Monday afternoon class, and he's at 100% success rate here in the last 3 months, and not too shabby for a newbie at a brand new strategy. So if you're somebody that wants to learn the ins and outs of put selling, of course I would invite you to my Monday afternoon class. But David's been doing a great job there, and he had a follow-up question about how to think about managing those positions a little bit more efficiently, and whether we roll contracts before expiration or let them expire worthless, and how do we manage our buying power and all that good stuff. Got a question about T. Rowe Price as a dividend growth investing question. I got a question about how much money is required to get started with dividend growth investing and how to think about it if you're starting in the middle of a business cycle. And then if there are ever times that you would sell stocks before holding them for, let's say, 10 years as a long-term holder, if they hit a profit target or if other things come up. And then I had a question about Hershey's and if we can minimize the whipsaws of the market if you're doing shorter term trading. So if any of that content sounds interesting to you, I'd invite you to go and check out the recording of that class if you were not with me live here earlier today, if you're a premium member. And remember, David taught his portfolio management class here earlier today as well. And then tomorrow he'll be doing his technical analysis class. Remember, with this upcoming weekend being the 3-day holiday weekend, he will not have his normal Q&A class on Saturday, and I will not be teaching my classes on Monday on Labor Day, but I'll be back in action for dividend growth investing on Tuesday morning, and of course doing this video for you guys here on the free video on YouTube on Tuesday night. So lots of good content for you to sink your teeth into over the holiday weekend if you don't have your own plans. I might actually be going to Jackson Hole, believe it or not. All this talk about Jackson Hole and Jay Powell and the Federal Reserve and all of this. It just so happens I might be heading out there myself this weekend for a little weekend getaway. So I'll do my best to dig through the garbage to look for Jerome Powell's notes, and if I find anything of interest for you, I'll be sure to tweet that out. All right, let's talk about this next graphic here. So I just posted this to the website here late last night before I went to bed. And remember, these dividend growth investing posts are free for all of you. So even if you're not a premium member, you can access this part of our website. So like a lot of companies, we have kind of a freemium model. So some of our stuff is free, but then a lot of our stuff is premium. So certain stuff is definitely behind the paywall. But this is one of the few things here that you can access on our website. If you wanted to check out the data further for yourself. In order to find these dividend posts, you would hover your mouse over the blog tab on our website and then click on dividend growth investing when you hover over that blog tab right there. And this post is basically a way for us to gauge whether certain areas within the market are more attractive than not to be investing new dividend money into. And so remember, this is not necessarily driven by price directly, although somewhat indirectly it is, because most of you are aware that when price goes down, dividend yield goes up. But the point being, these numbers that you see here are not being driven by a trader mentality of relative strength or anything along those lines. What these numbers are being generated from are how many stocks would we consider in my dividend growth investing class to be attractive in the various sectors that are out there. And I try to update this once a month to help you understand that if you're looking to put new money to work right here, right now, that some of these areas might be of interest to you if there's a lot of stocks that are in those sectors that are in the so-called blue zone of the dividend stair-step chart. Most of you that have watched these videos of mine, like the video I did for you on Tuesday where I showed you Comcast, remember the dividend stair-step chart there, that's what I'm referring to. So when you read this, Comcast is actually a good example because communications is currently the most attractive sector from a dividend yielding perspective. And it's not just they have the highest yield or anything like that. It is comparing their current yield to their historically high yield. And so, a stock like Comcast is of interest when it has a 3% dividend yield like I showed you on Tuesday, but a stock like Verizon is going to have a completely different dividend yield history because it always has a higher yield. So each one of the calculations that I run out of the 600 or 700 companies that I do this on has a unique calculation, and that is all being factored into these numbers that you see here from a sector perspective as well. So anyway, communications remains one of the more interesting areas for new money, and then financials comes in immediately after that, with about 47% of all financials currently trading in the blue zone of the dividend stair-step chart, whereas only 13% of financials are in the orange zone, meaning overvalued. So if you're looking for value out there right now, the financials is an interesting place to find that. And I did have a good 10 or 15 minute conversation about the interpretation of this in my Q&A class earlier today, if you need to refer to that and my thoughts. And what I did there was I compared this month's graphic to last month's graphic to see where we saw any changes. And one of the key takeaways is that the market is now more appropriately priced today than it was 1 month ago. Of course, the market had been falling here recently, and so that set up that possibility. But basically 1/3 of the stocks that I do the calculations on would be viewed as attractive based upon the average high yield theory. 42% would be neutral, and then 23% would be overvalued. Whereas last month, the undervalued and the overvalued were nearly equal to one another. Now there's a 10-point differential between those two levels there because the markets have fallen and therefore dividend yields have gone up. So anyway, feel free to take a look at that. And as I say down below in the blog itself, remember, just because something is overvalued does not necessarily mean that it's a buy signal, right? I think we should all know that by now. It is a relative measure. It helps you understand the state of the market a little bit better, but it's not necessarily a buy signal because undervalued can lead to even further undervalued, just like overvalued can lead to further overvalued in bullish markets, but at least gives you a better understanding as to where you might want to target within the market when you're looking to put new dividend money to work based upon the average high yield theory. Also, I can see over here under our popular recent post, the trading rooms registration Must have been clicked on quite a bit to show up over here. And so David did put together our monthly calendar. Obviously today was the first day of the month, so we've already been off and running with it. But in case you missed that, feel free to go through the Trading Rooms registration if you're a premium member, and that way you can register for all of our September classes with just a couple of clicks. Instead of having to register for each class as you go into it, you can do it all at once here in the Trading Room registration area. Also, let's have a little chat here about our factor selector tool. And as you can see, now this is a couple days stale, so just FYI there, but we were able to keep momentum at the top just barely by the hairs on my chinny chin chin. Did the momentum factors stay up at the top, but you did notice that directly below momentum, a couple of the more conservative factors started to make their way higher. Low volatility has risen for 2 straight weeks, and dividend yield has risen for 2 straight weeks. And remember, when low volatility and dividend yield are rising, that's generally a sign that the risk appetite of the market is low, and it's not a great sign for bullishness. It's just a recognition of that. And then we did see quality nosedive all the way to the bottom. And remember, quality these days has a lot of technology in it. You know, one stock that I saw in the tech space here today that got hammered was Okta. I think it was down like 30% or something like that, judging by what I saw on the 9 at 9 this morning. Remember, that's something else. In addition to the dividend posts, you guys can access the 9 at 9 for free every morning on our website as well, regardless of your subscription status. And that just shows us which stocks are up and down the most in the pre-market. Anyway, Okta and a bunch of those software companies were just getting annihilated this morning. And so quality is a little bit peculiar these days because you got stocks like Apple and Microsoft that are some of the highest quality businesses on the planet, and they now are part of that quality factor. So when technology is in favor, quality then tends to do good. When technology is out of favor from a sector perspective, quality tends to suffer. And remember what I showed you 2 days ago when we were looking at the sector selector. Technology had been number 1 a few weeks ago, but they had fallen down into the lower half of the rankings here this week. And so with the fall in technology, we saw a corresponding fall there in quality as well. Low size as a more speculative asset class also fell. Remember, the Russell 2000 was the worst performer today. This graphic would not have considered that because this was done on Tuesday night. So it was kind of giving you a heads up in advance that the small caps are a place of struggle right now and more, speculative area. And then, value had a little bit of a pop higher week over week. And that kind of jives with what we're seeing there with low volatility and dividend yield, where defensive assets are the ones that are catching a little bit of a bid here on a relative basis lately. All right, let's go ahead and get back into the flow of things back here on the charts. And I'm going to do some 12 grid analysis now, starting with chart 5A. This is our asset class 12 grid. Remember, the background colors will tell us whether we have a bullish or bearish intermediate posture using the market forecast technical indicator, with obviously the green colors being bullish and the red colors being bearish. And as you can see, it's still the same 2 charts in the lower corners that represent our only bullish charts. And that was the case on Tuesday when I reviewed this with you as well. So nothing has changed from that perspective over the last couple of days. If anything, it's kind of worsened because remember, one of the key talking points on Tuesday was that possibility that with this overbought cluster signal on the dollar and with this sideways price action, maybe, just maybe, you're going to see a little bit of a stall out there at exactly the same place where the dollar rolled over back here on July 14th. Well, fast forward today, one thing that has changed is we now see that a breakout has occurred, right? I was saying we don't know. Is it going to break out to the upside or break to the downside? Because you're basically just resistance, resistance, resistance for like 6 or 7 straight days. Well, today was the breakout day, right? So that's an important day. Dollar was up 0.89%. Surprisingly, the stock market still hung in there like a champ, but you can see the dollar did close well off of its highs. So whereas we've got these long lower shadows on the markets themselves, like the S&P 500, like EFA, like EEM, notice we got those long lower shadows on all of those stock markets. We kind of have the opposite here on the US dollar. We have a long upper shadow there. And so you kind of have conflicting signals. Yes, you had a breakout, and that would portend more bullishness, but you did close well off of the highs at a time when it seems like risk assets could have a chance of rallying for the coming days. And so maybe this was a head fake. Maybe this is all it took. Maybe there were a bunch of traders just sitting here waiting for the breakout to get involved bullishly, and the market has this uncanny ability to rip the hearts out of traders as often as it does. Maybe it was saying, okay, let's just wait for all of them to get bullish, and then we'll rip it back lower. So who knows? Be on the lookout for that possibility. Just saying that simply because we do have the long upper shadow there. But if you don't believe in that superstition, then it's probably best just to look at the trend. And the trend is still obviously bullish here in the case of the US dollar. Not only do you have a strongly bullish posture according to the green line on the market forecast, but you also have a green moving average suggesting prices above a rising moving average. So all else being equal, the path of least resistance continues to be to the upside, even if we have that potential of maybe a stumble in the ultimate short term. But the trend certainly remains quite bullish for the US dollar. And remember, that's not a great thing for the markets at large. So I would prefer to see a weak US dollar, but it's not up to me. Anyway, over on the right-hand side here in the lower right corner, that's where you're seeing TNX, and that's your 10-year US Treasury yield. And kind of same thing there. You got a breakout today. Now, you didn't have as much of a kind of a resistance buildup there in TNX as you had on the US dollar. It was kind of a more gradual upward ascent as opposed to a stalling out like we saw over there. But you certainly got your breakout kind of on the same day. I say kind of because the charts do look different. Today was a very important day on TNX. We had a good conversation about that in my question and answer session today as well, talking about some of the difficulties we have with my trading plan right now in the dividend growth investing class because of what's going on with the 10-year US Treasury yield. But anyway, you can see that we closed at 3.26% today on the 10-year. Remember, it wasn't too long ago here, just at the beginning of August, yes, 1 month ago, we were at 2.5%, somewhere very close to 2.5%. So we've gone up 75 basis points basically in a straight line. That is about as sharp of an ascent as you're going to find in the interest rate environment out there. Typically, there's more gradual movements in the interest rate world, but this has been basically a straight line up of 75 basis points. That's a big move. They were saying on CNBC today that the 2-year, so this is the 10-year here, but they were saying that the 2-year you could get 3.5% yields on, right? Because we have an inverted yield curve right now where the 2-year has higher interest rates than the 10-year. And so, like I was saying to my class earlier today, I've never been like a huge proponent of the bond market personally. I'm much more interested in the dividend income that can be achieved because dividend stocks can also appreciate quite considerably and dividend stocks can grow their dividends over time, whereas bonds are called fixed income for a reason. So I've always leaned much more towards dividend stocks. Most of you know that about me. That's not a surprise. But I will say that given what we see with the 2-year Treasury yielding 3.5% right now, that's not a bonkers idea anymore. Like a couple of years ago, if you told me you were going to let the U.S. government have your money for the next 2 years and they were only going to give you 0.1% in return, I would have kind of looked at you funny. But today, I don't think I'd look at you all that funny. I'd say, you know what? That's somewhat rational. I think that's a reasonable trade-off. You give the government your money for 2 years. They give you 3.5% along the way in income, and then they give you all of your money back in 2 years. And then you can, you're free to use that money however you want. And maybe the stock market is way lower at that time, and you can get even better values. Who knows? So, we'll see where this takes us. But I do find the government bond market to be much more interesting here all of a sudden than I ever have in all of the years that you guys have known me. So I'll float that idea out there for those of you that might have an interest in that. Notice that when the Treasury yield goes higher, as we did quite considerably here today, that you should assume that bonds will fall. And that is what we found. TLT was down sharply today. It was down 2%, and it actually closed with another oversold cluster signal. We've had quite a few of those here recently, so it's not the most unbelievable thing the way it used to be years ago. It seemed like when we'd get one on TLT, it was like spotting a a dinosaur or something, or a unicorn, right? Like, it's just something you never saw because the bond market kept on going up because interest rates kept on going down. Fast forward to 2022, we've seen a lot more of those oversold cluster signals because we've seen a rising interest rate environment all of a sudden. So today we got another oversold cluster on TLT, a sharp move lower. But just like we had a longer upper shadow on TNX, we had a longer lower shadow on TLT. It's not quite as straightforward as some of the stock markets because we close at the high on the stock markets. The bond market kind of closed in the middle of the range, so it's kind of an uglier candle. But it is true that we do have a lower, long lower shadow there that at least sets up the possibility that, hey, combined with an oversold cluster signal, maybe we can get a little bit of a rally in the bond market. Maybe things have gone up too far too fast with interest rates themselves. You'll notice here that the foreign bond markets also have another oversold cluster signal. This is actually their fourth one in the last couple of weeks. And then high yield bonds also closed lower today, although they closed well off their lows, and they did close at their highs, unlike U.S. government bonds, and you do still have kind of a long lower shadow there. So remember that high yield bonds will behave a little bit more like stocks because they're corporate bonds that require a strong economy in order for them to pay off for investors in many cases. And so when the stock market catches a bid, the high yield bonds, all else being equal, will likely be able to keep up with the stock market a little bit more so than the other bond categories. So we did see that phenomenon play through today. But despite that, they still all closed in the red, and they all still have red moving averages, suggesting that if we do get some sort of a pop, it's kind of similar to the markets themselves, the stock markets. Don't know how much we can trust it, right? In the ultra short term, sure, we can get a bounce here, but it's the intermediate term that many of us care about, or the longer term, and that picture is still quite cloudy and still leans a little bit more bearishly at this moment in time. As I mentioned, you did still have sell-off days with the foreign markets up above, but you have those long lower shadows, so maybe we catch a bid there. But EFA was down 1.35% today for the developed foreign stocks, and then the emerging foreign stocks closed down only by 0.79%. My guess would be they were probably down more sharply than EFA was in the morning, which emphasizes the recovery even more so to end up closing lower by less than EFA. So there was a pretty strong rally there by EEM at the end of the day. Not enough to reverse the posture or to reverse the moving average, but at least a starting point after a pretty sharp decline here in the last week alongside a lot of other risk assets. Bitcoin didn't really move much. It's still stuck at 20,000, by the way, so that's probably not a great sign there either. All right, let's take a look at some sector analysis now with chart 5C. As we look at this, you can see we now have a clean sweep of bearish postures across the board. Remember, on Tuesday that was not the case because XLE had a green background color. But here we are 2 days later, and with energy stocks falling in the last couple of days, there's been enough wear and tear where that posture has now gone to weakly bearish, just like we see here with utilities, right? And the reason we know that very clearly is because you have that light pink background color. All of these other charts have the darker shading of pink, telling us that we have strongly bearish postures on the rest of them. Of these, different charts here, I would say that utilities kind of looks interesting because you had this pullback on utilities to the rising moving average. We talked about this on Tuesday as well. And coincidentally, that rising 30-day moving average lines up nicely with where this prior resistance was on XLU over here. So you had this breakout of this resistance. Now we're retesting that resistance, hoping that it becomes support. And it just so happens that it's happening exactly at the rising moving average as well. So you have kind of a confluence of events there that suggests that maybe we can get another bounce out of utilities here. Today certainly helps, build that case because as you can see, let me right click and maximize this chart a little bit more. This was an impressive candle on XLU today. This is a bullish engulfing candle at a support area. And not only that, but you can see that the moving average went from yellow back to green today because we're now back above a rising moving average again. Yesterday we closed slightly below that rising moving average, which is why it changed to yellow at that time. But today was a good response there. This is the type of day you want to see if you're trying to be bullish on utilities again. And remember what I mentioned on Tuesday when we looked at the sector selector, the utilities is the only sector that has been consistently strong in the top 4 rankings of the sector selector over the last 3 months. It's the only sector that's been able to make that claim. All other sectors have been in and out of the top 4. Utilities have been firmly in the top 4 the entire 3-month period. And so they are an area that has some relative strength. Now, whether you want to go overboard with that concept and get really bullish in what is clearly a very difficult overall market, I'll leave that up to you. But in general, if you like the idea of trying to hunt down relative strength, then the utilities are one of those remaining areas where you can find it. And this is a pretty good look where you want the chart to bounce from, right? If it would have continued to sink below that moving average, then all bets are off. But this is a good response here. This is where you want the bulls to step up for the utility shares, and that's what we did see at least on a one-day basis today. Now you still have, a downward diagonal resistance area that you got to break through, so we're not out of the woods. But if you needed a start and you needed a little bit of a hope at the end of the tunnel, a little bright light at the end of the tunnel, then you got it here today. Bullish engulfing candle right where you needed it to find some support. So keep your eyes on utilities. Energy is kind of similar, but not 100% exactly the same. So let me explain. So energy does have the weekly bearish posture, which is similar to what we saw on utilities. So they share that commonality. They also share the commonality that they're both above the rising 30-day moving average. But their chart shape does look different. Remember, with utilities, we pulled back to that prior high area from 3 months ago. With energy, that's not the case. The high over the last 3 months was back here on June 8th, and so this is clearly a lower high that we've established. It's not a breakout retest situation like we saw with utilities. And then the other thing I would say is this is not a bullish engulfing candle today. As I mentioned before, almost all energy stocks were in the red today. It was one of the only consistently red sectors that was out there. Yes, it closed well off the lows, so we got to give it that credit, but this was still a very ugly day for XLE. It was down 2.5% on a day when the market was up. So that does not look as bullish as what we saw on utilities with that bullish engulfing. Now, it doesn't mean that this can't lead to a bounce. It just means that of the two, the utilities chart looks a little bit stronger to my eye at this moment in time. All these other charts, as I mentioned before, do have the dark pink shading telling us that we have strongly bearish postures. And of those, a number of them also have red moving averages, including communications, including technology, including materials, and including healthcare, right? All of those have dark pink background colors combined with red moving averages, which is a trickier situation for short-term traders. Now, it can be a better situation if you're looking for value as a longer-term investor. So, you have to kind of decide for yourself what you're looking for out of the market. But since this, caters a little bit more towards the trading community, this video does, then we usually kind of speak more directly to you guys as opposed to those of you that might be in my dividend growth investing classes or my options for long-term investors classes where we might be willing to gamble a little bit on some of those areas, right? That's what I did with you guys on Tuesday when I said communications looks so bad, it was getting good. In other words, it had come down so sharply that you were close to a support area over here, which is why we selected Comcast out of the communications area to do a bullish trade on. And as I mentioned before, not only has Comcast gone up 2 days in a row, but actually communications has, just barely, but you have black candles here the last 2 days. Yesterday, it just barely closed positive. Today was a little bit more of an aggressive 1% move. So far, so good on that. And that actually is a pretty good segue for today's trade idea, because I want to concentrate on the materials sector, which is kind of the same thing. It's not identical, but gives you the same impression where it's cut sharply below that moving average, where it's kind of nearing some of these lows from a few months ago once again. And you've had 5 days in a row to the downside for materials, and it makes you wonder, are we in store for some sort of a snapback rally, at least in the short term? And if so, is there a way to try to take advantage of that? And as I mentioned kind of earlier in the presentation, those of you that follow me closely enough on Twitter will not be surprised as to what the trade idea was that I brought to your attention. So let me go back over to Twitter to catch everybody up to speed who might not follow me there already, so that way we can kind of talk through this idea. The stock that I'm trading here for the application example tonight is IFF. So Indigo Frank, and this is a stock that's not all that well known, but is a little bit more well known within the dividend growth investing community. This is International Flavors and Fragrances. It's kind of an interesting little company. I shouldn't say little because it's actually worth $20 to $30 billion these days, but it's a company that is kind of behind the scenes and helps perfume companies get just the right scents and provides those materials and those chemicals to add into the perfumes. And it goes beyond that. Obviously, it's flavors and fragrances. And so a lot of the food that you will purchase from the grocery store or even at a restaurant will have special flavors in them that many cases are proprietary, that are coming directly from International Flavors and Fragrances because they've teamed up with whatever food company you've bought that food from. And anyway, it does have a longer history of growing the dividend. In fact, I was looking at it on the CCC spreadsheet here a moment ago, and you can see that they have 20 years in a row of dividend increases. So similar to the conversation I had with you guys with Comcast on Tuesday, it's not an aristocrat because it doesn't have more than 25 years in a row of increases. Comcast is at like 15, and this one, IFF, is at like 20, but 15 and 20 years in a row of dividend increases is still pretty impressive if you think about what we've gone through in the last 15 and 20 years, because that will take you back past 2008 and 2009. So in other words, both Comcast and this company grew their dividend in 08, 09 when most other companies were cutting their dividend. So anyway, this one kind of showed up on my radar here today because many of you know I like to seek out some of those 3% yielders. And we talked about that with Comcast on Tuesday as well. Remember, for Comcast, that was its first time in history that it had a 3% dividend yield. Well, IFF has had it before, but it is still very rare. So like I say here on Twitter, IFF had a 3% dividend yield when it was below 108 today. When I took this screenshot, it was at 108.41. So it shows that the yield is 2.99%, but it actually did go below 108 earlier today. Anyway, it said this one doesn't get a lot of buzz, but it's in the oftentimes hard to fit for DGI purposes materials sector. And what I mean by that is there aren't a whole lot of great materials companies out there for dividend growth investing purposes because materials sector is very cyclical. The more cyclical the sector, the greater the chance is that it's not going to be able to maintain dividend growth throughout all economic cycles. So this is a rare one that's been able to commit to that for 20 full years, largely because it works with a lot of consumer staples, right? So while it itself is a materials company, its end market is the consumer staples, and the consumer staples are a good fit for DGI purposes. So it's kind of a sneaky way to get a materials company in your DGI portfolio, but to kind of dull down the extreme volatility of the economic cycle, knowing that its end customer is oftentimes a food company. Anyway, I say, as you can see from the red circles, it tends to stabilize pretty nicely when it achieves a 3% dividend yield. So these circles that I posted right here are where it in the past had a 3% dividend yield. This fourth one is today, but these other three were the other three in the last 3 or 4 years where that also occurred. Prior to this circle, going all the way back here on this 10-year chart, it never happened. So the first time in about 7 or 8 years that it happened was here in 2020 during the coronavirus wipeout, where it went down far enough in price to have a yield high enough to be at least 3%. It then had a rally after having that 3% yield, and then rolled over again later that year in 2020, touched it just briefly for just a week or so, and then immediately rallied after that And then here earlier this year in the summer when it ripped down, with the rest of the market selling off, it did touch a 3% yield there as well. So the point is, it's not a once ever situation like we saw with Comcast that I presented to you on Tuesday, but it is still a fairly rare situation that when we look back at the evidence of whether the stock stabilizes at a 3% yield, at least in the last decade, that has been the case. Now, one of the challenges is this is only a 3% yield right now, and the 10-year Treasury is currently yielding 3.27%. So similar to the Comcast story, instead of buying it outright right here, which you're perfectly welcome to do if you want, but it would chew up too much buying power in this account that I have for this presentation. So what I chose to do is to do another sold put trade. Now some of you might be saying, well, the market wasn't down over 1%, Brandon. That doesn't seem like your style. Well, keep in mind that I did this trade really early here today. It was actually a couple of hours before the market closed. And this morning the market was down over 1%. And so that's kind of a benefit for you as well. If you can kind of pick up on a few of these things here on Twitter and make a guess as to what my trade application example would be. Maybe it's kind of like a poor man's way of doing our Telegram app, which all of our premium members know about because I post that whenever I place the trade immediately. But for those of you that aren't premium members, maybe you just need to follow me on Twitter and stay tuned because on this particular trade, let me go over to it. Where are we at? It is IFF. We're already up $37 on it. Right? That's not the biggest amount in the world, obviously, but we only did one contract. Some of you might be doing more than one contract. So some of you might have been able to guess that, and even those of you that are premium members, you would probably be up on the trade already because markets did rally into the close there a little bit more. So let me go over here real quick and show you on the dividend stair-step chart. And by the way, this one does have a daily cluster, but since this dividend stair-step chart looks at the weekly clusters, you won't see it appear. But if you pulled it up on a daily candle chart, you would see an oversold cluster signal on IFF. But what I did was I sold the $90 strike in the month of October because that was the 1% return on risk. And I was able to get that for that particular trade here today. And if you were forced to take ownership of it down here at $90, if the market continues to roll over, remember that's what you're on the hook for when you sell a put, then your yield would go from the current 3% yield to a 3.6% yield, and that would obviously be well above the current 10-year Treasury yield. So anyway, it's a very similar trade setup to what I showed you guys there on Tuesday, and I'm happy to be back in the flow of things. As I was mentioning on Tuesday, I was kind of chomping at the bit to be able to present some sold put trade ideas to you again because that was my go-to strategy for you guys earlier this year. But then when the market just kept on going up and up and up between July and August, I wasn't able to do that strategy. But now that we've had this sell-off again, I'm able to start working that strategy a little bit more and giving these unique ideas to you guys. So if you enjoyed the presentation tonight, I ask one simple request out of you. Click like for me there on Twitter. Did you enjoy this conversation about me trying to uncover a few hidden gems out there? I'm sure a lot of you probably weren't looking at international flavors today, just like you probably weren't looking at Comcast on Tuesday. But these are the types of things that catch my eye. And when they catch my eye, I try to post about them on Twitter and talk about them in these videos as well. So if you felt like you got value out of that conversation and what I'm looking at and some of the stability of this specific stock around a 3% dividend yield, then you can say thank you to me by simply clicking like there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll plan on doing another full-length video like this one that'll include a trade application example. If we're under 100 likes, then I will plan on just doing a 15-minute index-only video with no trade application example. So I'll let you guys all decide collectively which you prefer out of those two choices, but mostly I want you all to have a fantastic 3-day weekend. I want to wish you all the best of success with your trades and your investments. Goodbye for now.